Hare Krishna. Welcome to Tax Guru YouTube channel. This is C. Rohana Pingale, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to the video series on Income Tax Act 2025. Today is episode 5. So let's dive into it. Let me allow to share my screen. Yes. So welcome back to episode number 5 of our complete Income Tax Act 2025 Master Series. So in our previous episode, that is in fourth episode, we began studying one of the most important parts of our any taxation law. So what is that? Statutory definition. So we learned that every provision of the Income Tax Act derives its meaning from the language chosen by the parliament. We understood concepts such as person, assessee, assessment, tax year, income, and total income, which form the foundation of what? Tax administration. So today we move to one step further. So in this episode, we shall study another group of extremely important statutory definitions that directly determine what? Taxability of the transaction. So consider a simple example. Suppose you sell a piece of land. Okay. So whether tax is payable or not depends on what? First, upon one question. Is that land a capital asset or not? If the answer is no, then there may be no capital gains tax at all. So similarly, whether an activity constitutes a business or a profession affects the method of computation of income. Okay, so maintenance of books of accounts, audit requirements, and various deductions also depends on that. So likewise, definitions such as dividend, transfer, agriculture income, property, and any and virtual digital assets are not merely academic concepts. They decide whether a particular receipt is taxable or not, exempt or chargeable under a specific head of income. So, one of the significant objectives of the Income Tax Act 2025 has been simplifying the language of what legislations while retaining the underlying legal principles. So therefore, throughout today's discussion, we shall also compare corresponding provisions of the Income Tax Act 1961 so that existing professionals and new learners can appreciate both the continuity and change. So let us continue building the language of the Income Tax Act. So moving further, let's understand why definitions are important. Okay. So definitions do much more than what explaining the meaning of the words. They determine what legal consequences. Considering the examples, a doctor earns consultancy fees. If this activity constitutes a profession, his income is taxed under what head? Profits and gains of business or professions. But various professional compliances requirements may apply to it. So suppose an investor sells agriculture land. Whether capital gains tax applies depends upon what whether the land qualified as a capital asset or not. Also, similarly, a shareholder receives a distribution from a company, then whether that receipt constitutes dividend depends entirely upon what the statutory definition of it. So, likewise, a person transfers cryptocurrency. So whether that asset qualifies as a virtual digital asset determines what the special taxation provisions of applicable to that particular type transaction. So thus statutory definitions are not merely what descriptive. It requires, it is a base. So it is a foundation. It's operate as a gateways that determine the applicability of a charging provision. So professionals therefore always begin legally analyzing what by examining the relevant definitions before reading the charging section is what the important of the definition part. So let's start with a definition of a capital asset. So among all the definitions contained in the Income Tax Act 2025, the definition of a capital asset occupies a central position. Why? Because capital gains taxation begins only if the asset transferred is what capital asset then only. So the expression is deliberately drafted in very wide terms. So legislature adopts the expression property of any kind, indicating that almost every form of property owned by a person is capable of being regarded as what capital asset unless specifically excluded. So the term property itself has an what extremely broad legal connotation. It includes what tangible property, immovable property, movable property, rights, interest, intellectual property, securities, financial instruments, digital assets, wherever covered. So the parliament intentionally gives capital asset a broad scope so that taxation keeps a pace with evolving economic commercial realities. So this definition is therefore what inclusive in nature. So its practical application while expressly excluding what certain categories that Parliament doesn't intend to tax under the capital gains provisions. Moving further, let's understand what can constitute a capital asset. So many students or professionals mistakenly believe that the capital assets consist only of what land and buildings. So legal meaning is much wider. Let's see examples. Immovable property, residential house, commercial building, factory, plot of land. Under movable property, jewelry, paintings, sculptures, artwork, motor vehicles. So financial assets also include shares, then debentures, mutual funds, bonds. Then intangible property includes goodwill, copyright, trademark, patent, brand name, business rights. And then under digital property, with the evolution of a taxation, digital assets have acquired what increasing importance. So virtual digital assets received separate statutory recognition under the modern tax legislations. Very important. So the important lesson is here is that capital asset is not confined to physical objects only. Even valuable legal rights may constitute what capital assets. So let's understand one illustration. Suppose Mr. A owns residential flat, equity shares, trademark, copyright, commercial plot. Then each of these may qualify as what capital assets subject to what statutory provisions. Let's see what assets excluded from capital assets. So the definition is extremely definitely is a broad enough. Parliament intentionally excludes certain assets. What are they? These exclusions are equally important because the taxation depends upon them. So some important exclusions include stock in trade. So assets held for trading are not capital assets. Okay. So example, a jewelry inventory, a car dealer's vehicle, these are the business assets rather than investment in assets for them. Then personal effects, certain movable personal belongings used for personal purpose are excluded. For example, wearing apparel, furniture, personal household articles. However, important exceptions what exist. So jewelry is generally not treated as a personal effect for this purpose. So similarly, certain works of art continue to remain capital asset despite what personal ownership. Then certain agricultural land which covers specified rural agricultural land continues to remain outside the definition of the capital asset. That is rural agricultural land. So consequently, its transfer may not attract what capital gain tax subject to statutory conditions. So let's see a practical example in that case. A farmer sales rural agricultural land. The first question arises that land capital asset. If not, then the capital gains taxation, of course, ordinarily does not arise. So the definition itself determines what taxability. Very important to know. Moving further, let's see comparison between the Income Tax Act 1961 and Income Tax Act 2025. Under 1961, it deals section 2, subsection 14. Here, reorganize the definition under the Income Tax Act 2025. Similar legislative intent and here simplified drafting and broad concept what retained. So, and here it is a better readability. So nothing much change over compared to what your Income Tax Act 1961. So concept of capital assets has largely continued from the 1961 Act to the 2025 Act. So the broad expression property of any kind continues to form what foundation of the definition. However, Income Tax Act 2025, the presentation has been what modernized. So key observation is same as that the language has been simplified. They are trying to that the main object of the new act is that only. So definitions are organized more what logically. Cross references have been reduced wherever possible. So the legislative objective is improved what reliability rather than the substantive change. So accordingly, professionals familiar with the 1961 Act, those with that act will definitely continue in the principle, while students studying 2025 at first time will benefit from the clearer drafting. Moving further, let's see definition of the business. So the expression business is intentionally drafted in broad terms like capital asset. Parliament recognized that commercial activity continues evolve, so therefore the instead of restricting that is the exclusive, it is an inclusive type of right. So business to traditional buying and selling activities, the definition extends to numerous form of the organized economic activity. So business ordinarily includes what? Trade, commerce, manufacture, any organized commercial activity, right? Adventure, concern in the nature of trade. So the last expression is particularly what significance, that is adventure and concern. So even single isolated transaction may what constitute your business activity if it possesses the characteristics of a commercial nature. Very important to note. So the frequency alone does not determine the business. It is not required the 100 activities, 100 plus activities or one activities. Okay. It is what important is the commerciality. So the intentions, surrounding circumstances and commercial nature of the transactions also becomes what relevant. So this principle has been repeatedly reorganized, recognized in a tax jurisprudence. Let's see illustration. A person purchased land solely with the intention of what? Immediate resale at a profit. Although only one transaction is undertaken, okay, but it will still constitute an adventure in the nature of trade depending upon the facts. Okay, even though it is a one transaction, but if it is a commercial nature, it becomes a business. Next, let's understand characteristics of the business. So no single test conclusively determines whether an activity constitutes business or not. Courts generally consider several what indicators like intention to earn profit, that is very much important, organized commercial operations, continuity of the activity, reputation, business infrastructure, risk taking, commercial planning. So everything should be considered while determining whether the activity is business or not. So none of this test is individually decisive, right? So for example, share trading undertaken regularly may constitute business, right? So the same shares held as investments may generate what capital gains instead of the business income. So the facts determine what classification and professional judgment therefore becomes what extremely important and a judicial interpretations. So let's see comparison. So students often confuse business with a profession. Okay. Many professionals also may make mistakes. Although both are taxed under the same heads of income, they are conceptually definitely different. That is, business is different and profession is different, right? Business is a commercial activity, professional is a personal skill. Whereas it is business is a capital intensive, whereas professional is a knowledge intensive. Business is a trading where professional is a expertise and it is a business organization. Here is a profession is what back with what qualification. So examples of the business, as I said, manufacturing, retail trading, wholesale distribution, import, export, whereas a profession on the hand is based primarily upon what specialized knowledge, like doctor, chartered accountant, architecture, film industry professionals, directors, like that. So these are the, I mean, the advocate, very famous examples. We can differentiate between the business and profession. So this distinction is important because the several provisions relating to the books of accounts maintenance and that the presumptive taxations, audit, and professional obligations differ depending upon whether the activity is classified as a business or profession. So very much important because 44 ADA is applicable to professionals, 44 AD is applicable to the business activity. So there it is helpful to us. Let's see definition of profession. Having understood the concept of the business, let us now study what profession. In ordinary language, profession refers to an occupation requiring what specialized education, training, intellectual ability, and ethical standards and a skill So Income Tax Act also adopts this broad understanding. So profession is generally distinguished from the business because the primary source of income is not a trading in goods or services, but rendering what specialized personal services, which is backed by the professional skill, education. Example includes chartered accountant, as I said, advocates, doctors, architects, engineers, company secretaries, cost accountants. So the distinguishing feature is that income flows primarily from what? Knowledge, expertise, experience, and a professional judgment rather than from buying and selling of the goods. So another important feature is that professionals are usually governed by what? Statutory or professional bodies. They have associations, but business is not like that. Business associations are very different. Professional bodies are also different. That is like a chartered accountant, Bombay Chartered Accountant Societies, ICAI, then doctors association are there, advocates have a bar association. So for these are the examples. So the existence of a statutory regulator is not an absolute requirement. So, but real test is whether the activity substantially what depends upon the specialized intellectual skill is not. So moving further, let's again see a practical comparison between the business and profession. Like commerce, profession is expertise, business is a training, profession is a skill. We already seen this, but both are taxable under the head profits and gains of business or professional. Okay, let's see few examples. A person owns what? Supermarket. So his income arises from a trading in goods. So this is what? Business. A chartered accountant provides audit services. So his income arises from what? Professional expertise. So what is it? Profession. Very simple, right? Let's moving further. Let's see comparison with the Income Tax Act 1960. So definition of the profession under the Income Tax Act 2025 substantially continues again the position under the Income Tax Act 1961. Nothing has been changed. No major change here. No significant conceptual change, right? So instead the changes are primarily what? Legislative, simpler drafting, language simplification, better organization, easy readability like that. So the underlying principles remains what? Unchanged. Let's see definition of a company. So one of the most important taxable entities under the Income Tax Act is what? Company. So we often assume that a company and its shareholders are the same. So legally they are what? Completely different. The company possesses an independent legal identity, right? So it can own property, enter into the contracts, be sued, borrow money, earn income, pay tax, all in its own name, right? As individual. So principle originates from company law and is fully recognized under the income tax law. So consequently, when a company earns profits, the company itself becomes liable to what? Income tax. Okay. Shareholder are separately taxed in their hands wherever the law specifically provides. Let's understand by few illustrations. ABC Limited earns 50 crore profit. The company pays tax on its taxable income, of course, and the shareholders are not taxed merely because the company earned profits. Okay, they become taxable only when they receive the dividends or other taxable distribution as provided under the Act. Let's see types of companies recognized: domestic company, foreign company, government, public and private companies. So the Income Tax Act contains what general definition of the company. Taxation often distinguish between the different categories. Let's understand domestic company. A company incorporated in India or treated as what? Domestic under the Act. Foreign company, a company incorporated outside India becomes what? Foreign company. So taxability depends upon the residential status, source of income, and other statutory provisions. Government company, companies owned or controlled by whom? Government are government companies. So provisions, special provisions may apply in specified situations. Then public and private companies, these classifications primarily arise under company law, but may also have an income tax implications in certain context. So wherever you read the expression company, always ask which type of company, like domestic, foreign, private, public, or government, non-government company, right? That is the important thing. Let's see comparison with the Income Tax Act. So again, Income Tax Act 25 continues with the long established concept of the company under the Income Tax 1961. No substantial conceptual change. So emphasis has been definitely on what? Simplifying the statutory language, removing unnecessary complexity, improving reliability. Okay, nothing major change in the definition. Let's see definition of now firm and partner. So the Income Tax Act recognizes a firm as a separate taxable person and a partner is also a separate taxable person. So this is an important concept. So many students may mistakenly think that the only companies are separate taxpayers. In fact, partnership forms, LLP, limited liability partnership, are also what separately now recognized under the Income Tax Act. Not now, but it is continuing. Another equally important definition is what partner. A partner is not same as what firm. The firm is one taxable entity and the partner is other taxable entity. So each of them are another different. So this distinction becomes important while studying what remuneration to the partners, interest to the partners, allocation of profits, assessment procedures, and filing of returns. Let's see illustration. Three chartered accountants form what XYZ and company. So the firm files its own income tax return, whereas each partner, that is the three partners, also files an individual return declaring their personal income and other taxable receipts. So the firm and the partners are the distinct taxable person. Let's see firm versus company. Firm is a partnership. Company is what? Incorporated. The Partnership Act, LLP Act defines the, sorry, governs the firm. Companies Act governs the company. Here, partners, here, what? Shareholders, directors, firm partnership agreement, and company deals with a memorandum and articles. So, both are taxable entities. Their legal foundations differ what considerably, right? Ownership in a firm belongs to collectively of the to the partners. In a company, ownership belongs to shareholders. So these are the major differences. So now moving further, let's see definition of who relative. Very important. So, unlike the ordinary English, the Income Tax Act assigns a specific statutory meaning to the expression relative. So, many people casually describes cousins, close friends, or distant family members as relatives. However, Income Tax Act recognizes only those relationships specifically included within the statutory definition. So, this definition assumes significance in numerous provisions, particularly those dealing with the gifts, specified transactions, exemptions, anti-abuse provisions. So therefore, whenever the Act uses the expression relative, professionals should never rely upon what dictionary meaning. They should see the Act to refer the definition, okay, and to interpret what is ever comes before that. So they must refer to the statutory definition as I see. So suppose a person receives 20 lakhs as a gift. Whether it is taxable may depend upon entirely upon what? Whether the donor qualifies as a relative under the statutory definition. Okay. So one definitions can completely change the tax consequences. Let's see agriculture income. So now we arrived at one of the most frequently discussed concept in Indian taxation, like relatives, agriculture income. So this definition has both a constitutional and tax significance. Under the constitutional framework, the power to tax agriculture income belongs to what? Primarily to the states. Okay. So consequently, agriculture income generally enjoys exemption under the Income Tax Act, subject to what? Statutory provisions. However, every receipt from a village or every income connected with the land is not agriculture income. Very important to know. So the statutory conditions must be satisfied to cover within the definition of agriculture income. So broadly, agriculture income is linked to agriculture land, agriculture operations, agricultural produced. So it is producing arising from such operations, then income derived from qualifying agriculture activities. So courts have consistently held that the basic agriculture operations such as cultivation, sowing, planting, and similar activities are fundamental to the this particular concept. So merely owning agricultural land doesn't automatically make every receipt from that is agriculture income. So let's see comparison between the 1961 and 2025 Act for agriculture definition. So concept is definitely again continues the long established principles under the 1961 Act. Statutory framework and legislative intent remain substantially similar, no change. So primarily changes are primarily only in the drafting style. Okay. So rather than it is what very simple, trying to simpling the language itself. No major change. Just let's see. So agriculture income may arise from rent, revenue from qualifying agricultural land, income derived from agriculture operations, income from processing agricultural produce, various types, income from sale of agricultural produce raised through agriculture operations. So concept of basic agricultural operation is fundamental. No machinery involved. So this includes ploughing, tiling, sowing, planting, irrigation, weeding, all these operations involve human efforts, right? Not machine efforts. Human efforts is very important. Human effort on the land and are the foundation of the agriculture. So secondary operations such as harvesting, drying, cleaning are recognized only when they are connected with the primary agriculture operations. Let's understand one example. Suppose a farmer cultivates wheat on agricultural land and sells the harvested crop. The income generally qualifies agriculture income because it directly arises from the agriculture operation. So, if the same person purchases wheat from others and merely trades it, then income becomes business income and not a agriculture income. So, the source of the income, not merely commodity, but what determines its what character. So let's see comparison between the 1961 and 2020. So same constitutional basis continued, similar judicial principles also continue, and modern drafting only is improved reliability. No major change conceptual. Now moving further, let's understand definition of the dividend. So the expression dividend is another important statutory definition. In ordinary commercial language, dividend means what? The share of profits distributed by a company to its shareholders. However, under the Income Tax Act, the statutory definition is what much wider enough. Parliament deliberately includes certain distributions which may not ordinarily be regarded as dividends, but why they did? Because taxation depends upon the legal substance rather than what merely the accounting description. So the statutory definition therefore prevents what taxpayers from avoiding the tax merely by giving a different name to a distribution. So when a company distributes profits or assets in a specified circumstances, the Income Tax Act examines whether that distribution falls within the statutory definition of the dividend or not. So accordingly, professionals should what never rely upon the solely upon the company law terminology. It must refer the Income Tax Act and it may assign a broader meaning to it. Let's see illustration. A company declares dividend after approval by its shareholders. Amount received by the shareholder is dividend, of course, under the ordinary as well as the statutory understanding. However, the Income Tax Act may also treat certain other distributions as dividend if they satisfy what the statutory condition. So this illustrates why the statutory definition always the prevails. Let's see comparison between the 1961 Act and 2025 for the definition of the dividend. So here also broadly continues the legislation policy adopted under the 1961 Act. Nothing has been major change here. New Act incorporates this development within a reorganized legislative structure. Important point for students here is the definition identifies what the constitutes the dividend, the charging and a computational provision determines how and when it is taxed. So the two aspects should never be confused. Let's see definition of the transfer. So among all the definitions in the Income Tax Act, transfer is perhaps what one of the most litigated one, very important. So here students or professionals think transfer simply means what? Sale. This is what? Incorrect. The statutory definition is much what? Again, wider enough. Transfer may include what? Not only sale, but exchange, relinquishment, extinguishment of the right, compulsory acquisitions, certain transactions involving what? Possession, other modes specifically recognized by the law. So this broad definition ensures that the capital gains taxation cannot be avoided merely by structuring the transaction in a different legal form. So the legislation therefore looks beyond labels to the substance of the transaction. For example, Mr. A exchanges his plot of land for another plot. So no money here includes, right? No money changes hands. But still there is what transfer because ownership rights have been changed. So similarly, Where rights in the capital assets are extinguished under specified circumstances, the Income Tax Act may still regard it as what? Transfer. So again, the comparison between the old act, nothing has been major change adopted here in the definition. Purpose remains the same. So over several decades, courts interpreted the expression transfer very broadly. Those judicial principles continues to be invaluable unless inconsistent with the revised statutory language. Now let's see definition of a property. The Income Tax Act frequently uses the expression property, right? So legally, property is much wider than the physical assets, as we have discussed earlier in today's episode only. So property may include tangible property like land, building, machinery, jewelry, intangible property like trademark, patent, copyright, goodwill, brand name, licenses, development rights. So the important principle here is that property includes not only physical object but also what valuable legal rights. So consequently, transfer of a right may also attract what tax even where no physical asset changes the hands. So now moving further, let's understand fair market value. So fair market value, that is FMV, commonly called as right, FMV plays what crucial role throughout the Income Tax Act. Whenever actual considerations cannot reliably determine the value, the parliament often substitutes what the fair market value. So broadly, FMV represents the price that an asset would ordinarily fetch if sold in an open market between willing parties acting what independently. So the concept appears in a numerous areas, include capital gains, gifts, business reorganization, virtual digital assets transfer, anti-abuse provisions, deemed consideration provisions. So here we want to understand that the FMV is not necessarily the price actually paid. It is what value determined according to the statutory rules. Let's understand next prescribed authority. So another frequently occurring expression here is what prescribed authority. So often we overlook this definition because it appears what administrative. However, it is extremely important. The income tax contains numerous provisions stating what as may be prescribed. What Income Tax Act contains what numerous provisions stating what as may be prescribed. So here it means what the detailed procedural requirements are contained in the rules rather than the act itself. So the authority responsible for performing specific functions under those rules is referred to as what prescribed authority. This mechanism provides administrative flexibility, right? So instead of repeatedly amending the act, procedural details can updated what through subordinate legislation. So thus professionals must always study what first act, then rules, notifications, and circulars they need to refer. So because all of them collectively govern what the tax administration. Now, very important again in a digital era, virtual digital assets, a new age definition we can say. So one of the most modern and significant additions to the Indian tax law we can say is the concept of the virtual digital assets VDA. The traditional tax laws were drafted when wealth primarily considered as what land, buildings, machinery, shares, and other conventional assets. But now, however, technology has transformed the global economy, and today people invest in what cryptocurrencies, digital tokens, non-fungible tokens, blockchain, then tokenized digital assets. So this is what recognizing this evolution, Parliament introduced this concept as a virtual digital asset, which has now been incorporated into the legislative framework of the Income Tax Act 2020. So the purpose is to ensure what the modern digital assets do not remain outside the tax system merely because they do not what fit traditional legal categories. So unless physical assets, a VDA may exist only in an electronic form. Yet it can possess substantial economic value and can be bought, sold, exchanged, or transfer also. So therefore, taxation follows economic substance rather than what physical existence. So practical examples of VDA crypto, as I already said, Bitcoin, Ethereum, cryptocurrency tokens. NFTs representing artwork, then blockchain-based digital collectibles, then other notified digital assets. So whether a particular asset qualifies ultimately depends upon the statutory definition and any applicable notification, and that is where the definition comes into play. So why was the VDA definition introduced? So let's understand the reason behind that. So before introducing this definition, tax professionals face practical challenges. That is, questions frequently arose: is cryptocurrency property? Whether it is a capital asset, whether is it a stock in trade, is it a commodity, is it a security? So answer all these questions. Different interpretations created uncertainty. So this introduction of a detailed dedicated statutory definition serves what? Several objectives. Like legislative certainties, taxpayer and tax authorities now have operate under a common legal framework. Prevention of tax avoidance means definition of VDA helps to preventing the tax avoidance. So digital assets concept cannot escape the taxation merely because they do not resemble the conventional assets. So, administrative clarity, assessment procedures become more uniform after introducing the definition. Future readiness, the definition is drafted broadly enough to accommodate technological developments. So, this demonstrates an important feature of a modern tax legislation. So, it involves with the evolves with what economy, that is the advanced mode of economy, digital era. So let's see comparison between the 1961 and 2025. So it is incorporated in the new act introduced later through amendments under the 1961, but here it is incorporated in new act separately. Separate better legislative integration and modern taxation concept is continued in the new act also. Now we are moving further. We have covered the definitions part two. Now we'll see common mistakes while interpreting the definition. So throughout the tax practice, several common mistakes repeatedly occur, like applying the ordinary English. Means Income Tax Act frequently assigns special meanings to the ordinary words. Okay. Never substitutes what dictionary meanings for your statutory definition. So ignoring then exclusions, since various definitions are inclusive, right? They have a broad but content specific exclusions also. So this leads to incorrect tax conclusions. So that is also one of the mistakes. Then reading only one provision. So definitions gain meaning only when they read together with a charging provision, computation provisions, exemption provisions. We need to do a proper research, ignoring the amendments. Many times we are not updated. Tax law evolves continuously nowadays. Professionals must always verify the latest statutory positions. Assuming similar words have similar meanings, for example, business, profession, property, capital asset, these are not the same terms. They are the different one. So, what will be the professional approach to reading the definition? So, read it completely, identify the purpose behind it, understand the context, study the illustrations if necessary, compare with the earlier law. So, very much this approach we need to follow. Means those who are in a litigation practice or may want to go, they need to adapt this practice. Need to first read the Bare Act, then rules, then circulars, notifications. You need straight from the what we say as a barrack, straight from the law itself. Of course, you refer the articles on your particular subject afterwards, but as a first, you need to study from yourself on a barrack because interpretations are subjective. One can read the words and interpret it differently. So that is very important. We need to have a build that practice to read from the source, real source, true source, that is the Barak first. Now let's have a recap what we have studied today. Okay, so we have studied very important definitions in today: capital asset, business, profession, company, firm, partner, virtual digital assets under the capital assets, agriculture income, transfer, property, fair market value. So all these are the important part, right? So I think that's it for today's episode. We will meet in a next episode. If any definitions remained, we will cover it in the next episode, or else we will further move. So thank you so much for patient hearing. If you have not yet subscribed Tax YouTube channel, then do subscribe for Tax YouTube channel. If you have any questions, observations, suggestions, then please do let me know via WhatsApp, email, or you can also comment below the particular video. So stay tuned to the Tax YouTube channel for latest updates and video series like this. Thank you so much once again. Bye bye. Take care. See you soon. Hare Krishna.